I think the best private equity deals work where you already know before you enter into the transaction how you're going to improve the company. So having a bit of knowledge about how you're going to improve the company is going to help you move the company to another level.
Welcome to the US UK Tax Talk podcast. Today I have the pleasure of being joined by my colleague Ragavan from our corporate team, who heads up our private equity audience group. Ragavan's going to be talking to us about the heady world of private equity, what's involved in buying and selling companies, and we have a really good laugh along the way. I hope you enjoy the episode. Ragavan, hi, good morning. How are you?
Hi, Aidan. Great to be here.
Thank you so much for coming in today, and thank you for coming in so well dressed. You are definitely my best dressed guest so far.
Well, I imagine the competition was very high, so thank you again.
I'm wearing my trainers, so it's definitely not the best dressed host, I can tell you.
Yeah, no white shots, yeah.
No. You very kindly came on today to talk to me about private equity, which I know is a particular specialism of yours, and it's something that comes up quite a lot in the private wealth space. And so what better way to talk about private equity than not by having a private wealth lawyer on, but talking to a corporate lawyer about this? Private equity has been a growing practice area of yours, am I right, over the last couple of years?
Yeah, well, actually, taking a bit, it's been more than a couple of years now. For my sins, I've been doing private equity for about 20 plus years now.
Yeah, I've definitely underestimated how long you've been doing it for then.
It's asset class has been around for a long time, but yeah, it's something that's always interested me. You're right that my bread and butter is corporate M&A, but because of the focus on my clients, I've often find myself involved in transactions where there's a private equity element. And as a corporate lawyer, I love doing deals. And if I can do deals in more spaces, then that's what I'm going to do.
So we're going to go through a couple of different things over the course of this podcast today, looking at sort of common deal structures and the sorts of common points that arise throughout the process when the lawyers tend to get involved. But before we get into the meat and potatoes of the deal, I kind of want to talk to you first about the fairly obvious point, which is when we talk about private equity, Ragavan, what is private equity?
Well, it really does what it says on the tin. It's kind of, it's just financing for companies, essentially. I would contrast it with debt financing, for example. So everyone knows about, going to your bank to take a loan out to buy an asset. So a lot of people do it when they're buying houses, get a mortgage from the bank. So equity financing is essentially people investing into a company by taking share capital in that company. And as the private would suggest, as part of the name, it's in private limited companies as opposed to companies which are publicly traded.
I think in my non-corporate brain about the times I know about people buying companies. My brain's thinking of things like Dragon's Den or these kind of shows. Yeah. Is this where we get into the distinction between private equity versus venture capital? When we're just buying companies, when do we give it the fancy name private equity?
The fancy name, yes. I always like to refer to it as the fancy name. I think it's just a distinction of timing a lot of the time. I think venture capital very much refers to potentially early stage investing. When, in my mind, at least, private equity is more mature prospects. So you're investing into a private limited company that's been going for a while, revenue generating. Venture capital, for me, is more kind of skewed towards early stage investing. So you're venturing. Yeah. Right. So that's why Dragon's Den is an apt example. So these companies haven't gained traction as yet. They're looking for capital in order to grow and develop the idea, whether they have a product or looking to develop that product by sorting out the IP licensing of it or whatever it is, the route to marketing. It's early stage investing traditionally. That's in my mind. At least. Yeah.
Who engages in private equity? My brain has certain large, scary sounding named companies like BlackRock. As a famous example, I think.
Yeah, and there's also Blackstone. No, there's two. It's very confusing.
But like, who decides our market for profit is going to be buying and selling companies? It's large institutions that engage in private equity.
No, well, I mean, the key is there in your who decides who's going to engage in this for profit.
Sure.
I think anyone who wants profit can engage in private equity. I think often institutional investors are kind of there in the public consciousness because we've all heard the names and invest into large companies. But private equity is something which family offices and much smaller investors do as well. You can have business angels. Very wealthy individuals often want to deploy their capital and make it work in the most efficient way possible. So that involves investing in a variety of assets. So that could be metals, it could be having exposure to, FTSE 100, but also could be investing into private companies. Now, want to caution, if I get myself into trouble here, private equity, I'm not suggesting that people off the street can just engage in private equity willy-nilly, and it's not a sensible thing for the ordinary person to do. But in terms of people who do want to invest their money wisely, we're not providing investment advice or any kind of legal advice at all. It's just something which a lot of people who are not institutions do. So a lot of wealthy individuals could do it as well. Family offices, you may have heard the term, do it. Business angels, and you may have heard that term as well. So wealthy people who maybe have been successful in their own right as business people.
So a famous example of, say, like Elon Musk bought Twitter back when it was still called Twitter, and he bought the entirety of Twitter.
Yeah.
That still counts as, we would still put that under the umbrella of private equity?
Well, I guess that would be a merger and acquisition.
Right.
So this is, so I guess if we're talking about the structure of it, so what we're talking about is the financing of a deal. So it's debt financing, which is from a bank, and equity financing, which is shares in a company. So, for example, a private equity structure could be, you could set up a special purpose vehicle, so a company, and then you could find a target that you want to acquire, and then you finance that special purpose vehicle in order to have the money to acquire the target. So you'd have loans going into that kind of topco special purpose vehicle from a bank, which we secured, but then also you'd have people taking share capital in that company, and that's the private equity bit of it. They're putting in money and getting shares in the company.
That's the phrase equity.
Yeah, exactly. And there's many different structures. And if you're leveraging a deal, and by leveraging I mean you're relying on bank money in order to be able to make your equity go a lot further.
This is a leveraged buyout.
Yeah.
My brain's using phrases I've heard sometimes.
Maybe if you throw phrases out, I'll listen to them, and then I'll probably correct it. No, it's a leverage deal because you're using the debt finance, and it could be a leverage buyout because you're buying out the existing shareholders. Yeah, and you can have a leverage management buyout, because I think an important point that I wanted to get across as part of our conversation is that private equity is a way of funding companies, but I'm a great believer in the team behind the people deploying the capital. So it's often as important that you have the right equity funders as the right team in place in terms of the CEO, chief financial officer. The people on the ground of the company who are going to develop your money are equally as important as the network that money can plug you into, and also the resources that money can probably assist you with.
And you did allude to something there that I thought about raising later, but it was a really apt time to talk about it. You used the phrase management, I think in the context of maybe a management buyout. In my mind, when I hear the phrase private equity, I'm thinking of big company coming in and buying smaller company because they think they can generate a profit from smaller company.
Yeah. Big bad private equity.
Which sometimes suggests that you're doing it adversarially, or that the smaller company hasn't had the, they're being acquired whether they like it or not.
No.
But it's often more collaborative than that, including sometimes to the point where the management are themselves buying the company.
And they've been backed by private equity. I mean, the best deals are where people are aligned essentially. Because let's not be naive about it. Everyone wants to make a profit. That doesn't mean people have to lose out or be done out of their business. What it does mean is that at the start and inception of any transaction, people need to be clear what the outcome people are shooting for is. And there's always an exit. In my mind, you should always be planning for an outcome if you want to achieve a good outcome. If you just have no idea, then you're probably things are not going to end up well.
I suspect you've also answered the question I was about to ask, which is, I know what's in it for the acquiring company. They want to turn a profit. They think they can find a way of increasing the profit and then maybe sell on later at a greater price. If I'm the target company and I'm the existing shareholders of the target company, and I'm thinking about, why do I sell to a private equity backer rather than any other form of process? Do I care as the selling party who's buying me and why? Are they injecting more than just money? Is it they're providing skills to allow us to grow?
That's a really interesting point. I guess kind of depends on the deal you've done a lot of the times, because if you're cashing out immediately, then you may think, I don't care. What do I care? All I care is they have the money to buy me out.
Sure.
If your consideration is linked to the future performance of the company, and then you know that
when you say consideration, you mean like you get paid based on the company continuing to perform.
The money you're getting. So
you're going to use the phrase EBITDA, aren't you? I've heard
multiple EBITDA. Going to use all the acronyms. No content, just lots of acronyms.
Purchaser ties your remuneration out of the deal to the continued performance of the company.
Yeah, exactly. Yeah. Thank you, Aidan.
EBITDA, something.
Yeah, exactly. If there's an earn-out structure, as you've quite succinctly summarized there, where the continued performance of the company has an impact after you've sold your shares, has a impact on your potential upside, then you're going to be potentially more interested in the custodians of the company now that you've left. I mean, there's ways within documentation. We're straying away from private equity into M&A. How, as a seller, you can protect your position and ensure that your cash you're getting is not manipulated by having contractual restrictions in the acquisition documentation, kind of setting out what the acquirer can and can't do, and making sure they don't fire all your best salespeople because they're too expensive, and there are things you can do that way, but it really does depend the deal you've done on the exit.
Sure.
If that's not a concern, but also a lot of people have concerns about how their employees are going to be treated. If it's their own business, if it's their own, well, it's just nice to do. If it's been their baby for their company, they've grown it from, they've been the sole employee to however many employees, and you sometimes you feel some kind of ownership and responsibility for people, the lives of people who've taken on the journey and who've been in the trenches with you during the course of the growth of the company. So you want to ensure that you're dealing with investors and buyers who are going to carry on the journey of the company, and ensure it's not a full stop, or ensure it's not a short-term play where it's ripped apart and sold, broken apart for the high place.
Which we've all heard sometimes occurs.
Yeah, and that's why sometimes private equity has a bad reputation. But if you pick the right investor, and I've worked with a lot of nice investors, it doesn't need to be adversarial. It doesn't need to be a zero-sum game. It should be, in the best scenarios, people coming together to take a company from one level to another level, with private equity potentially bringing along not only the capital, but the resources in terms of network, professionalism, to actually have a company achieve its full potential. When it works well, it can work really, really well and be really powerful in terms of everyone stepping forward, junior management taking on equity in the new company, the new structure, and therefore being aligned, viscerally with the success of an entity. It's very powerful, giving people ownership of their destinies and tracking directly between their effort and their output into their pocket.
You mentioned investors and you working with the investors, which leads me on, I think, to the final question I wanted to ask you before we get to the kind of the structure of what private equity often looks like, which is who these investors are, and they're increasing turning towards the UK. So this is a podcast that is sort of straddling the transatlantic relationship between the US and the UK, and inevitably the US being the largest market in the world means I'm sure a lot of private equity is US dominated. You're seeing more of that coming to the UK. Is that true? And where do you see that happening and why?
See it happening across the board in different spaces. So it's not really linked to one sector, but it's definitely a growing trend, because I think there's a sense that assets in the US are slightly overinflated. If that makes sense. The companies' valuations are a bit too high, whereas in the UK there's a perception that you can get good value for your capital. So if you're a custodian of capital, either a family office or you're a custodian of your own money as a business angel or an institutional investor like your BlackRocks, whatever. Of course, a whole range of markets of people who want to invest from the US. They're looking at the UK as a safe haven for their money in terms of the assets they can buy in the UK are going to develop further, grow faster than potentially the same assets in the US, because the multiple that's maybe being attached to assets in the US is too high. So they're being valued too high, valuations are too high. If you've got a cheaper asset in the UK, you can make your money go further. So that's why I think valuation is essentially the key.
Yeah. Okay, thank you.
Yeah.
So let's think about the broad structure of the common types of private equity deals that you see. I take I take myself back to, you see news articles about, company gets acquired and there's a large sort of figure that's just sort of put to it.
Yeah.
And you have no sort of concept of the amount of work that's gone involved with people like you, Ragavan, but also I'm sure lots of other people getting that deal over the line.
Yeah.
What do these kind of timescales look like? If in practice, I want to purchase a company through this process, who am I looking to at the company to be the main leaders in that process? You mentioned some of the C-suite people already. How long does this process take? And what am I getting myself into in terms of the ride?
It's very much horses for courses because deals can be done in a very short period of time. I remember it's a very exciting motorsport space, I'll say that. And we did a deal over a weekend.
Wow.
Because if you have the people in the room and the motivation to do a deal, and there was motivations for a variety of reasons I won't get into, you can do it very quickly.
Wow.
A lot of documentation, but it's all about the goodwill in the room and what people are prepared to do. Sometimes I think deals drag unnecessarily, and I really hate that because it wastes everyone's time. So as much as possible needs to be done about understanding the motivations of the parties around the table and making sure that you use that to drive momentum. Now, I'm not saying a weekend is a usual time.
You wouldn't
period.
advocate it as part of your normal practice?
No, it wasn't fun. Well, doing it was fun, but it wasn't. It was a lot of hard work. So a more normal time period would be 4 to 8 weeks potentially. Some deals are longer, some deals are shorter. As I say, it really depends what you're trying to achieve. It depends how much on both sides is known about the target. If there's a long process where you need to DD the target, and there's not only legal DD, but there's commercial DD and financial diligence. It partly depends on also how well the company is run. If you have a really great target company where the CFO has their finger on the pulse and can pull you as many accounts and run as many reports as you need at the drop of a hat, it's great because you're onto a winner. It bodes well for not only the transaction and how smooth the transaction is going to be, but also hopefully the future outcome. As long as what they're telling you is all accurate. If they're doing it quickly, giving you information that's not worth the paper it's written on, but I think you may come to disclosure and due diligence later on a warranties and all that. But if they're efficient, then a DD process is going to be much easier. If they're not, it can take a fair amount of time.
Does that 4 to 8 week period also assume that there might have been some prior discussions about heads of terms and a deal sheet is brought to you saying, Ragavan, this is what we're proposing to do. Obviously, we need to get it over the line, but we've already ironed out the details? Or as the lawyer, do you often get involved, or would you like to often get involved at the sort of the deal negotiation stage?
Definitely like to get involved at the heads of terms stage. And that's actually where we often are involved. Before, a lot of work is done even before the heads of terms. So if you're sitting in a family office, these deals don't just land on your lap. To invest into a good company, there's a lot of competition because there are a lot of good assets and a lot of well-run companies in the UK. There's a lot of competition with deals. So investment directors sitting in a family office, they need to find the deals. So someone will come across their desk.
There's no real estate agent with photos of the shop window where you can pick, I like the look of that property.
And unfortunately, a lot of the best deals aren't going to be the people who are going to be most obvious, right? A lot of rubbish options and opportunities are going to be marketed very strongly to a wide number of people. So, it's a lot of effort, and I really feel for investor directors and people who run family offices trying to find adequate targets. They need to look at a lot of really, really bad opportunities before the right one comes along. And then when the right one comes along, they're going to be in a bidding war a lot of the time with other people who've heard on the grapevine, there's a company that's doing great things in whatever sector in the one they're particularly covering. So all that work needs to be done in both sourcing the company, doing some light DD in terms of before you expend not like DD in the legal sense, but in due diligence, just in the kind of sense of meeting the people involved in the company. Before you spend money on professional advisors, you need to understand yourself as an investment director, whether this is a team of people you can work with. Alternatively, it's not a team of people you can work with, but a management team you can parachute in to replace them. Working out, with the sellers, be prepared to do a deal at a sensible price, because it's not really worthwhile getting professional advisors involved if your offer is rejected out of hand, because that's wasting everyone's time. So a lot of hard work goes into even before the heads of terms. And then once you pick the right horse, I guess, once you've actually focused in on a target which you think there has some legs, it's going to go somewhere, then you'd probably want to start getting your professional advisors involved and in helping putting together some parts of the term sheet. So I think your sponsor, in terms, for want of better, on the private equity side, would be saying, well, we think this is the value of the company. We'll structure a deal with this amount of debt from X party. We'll put together these shareholders who'll bring about this amount of equity to the table. We think management should have this amount of shares in the new company structure going forward. So talking about incentivizing and aligning people. And they do all the hard work on the numbers to work out that they actually can fund this deal at a sensible level and in a way where the sellers are happy, and a way where management are happy, and a way in which all the investors are happy as well.
Is that a bit like, like there'll be some people who are sophisticated as purchasers of real estate, and my brain keeps going back to real estate as a comparison, just because it's the time people
it's a class of asset, yeah.
You might be quite sophisticated and understand what you want to purchase, but you might just be, I'm a wealthy person and I want someone to help me with this and I don't want to think about it. So you instruct a buying agent to help you pick a property, structure the deal.
Yeah.
When you're talking about the people...
Yeah, the people who originate in deals, it's an interesting skill set because it covers that finance, and a lot of the people have finance backgrounds themselves, but also corporate finance people. Looking at it from slightly, if we switch the focus away from the people who are looking to invest their own money to maybe an easier analogy of this, companies looking to get our money from private equity investors or investors because they want to grow their company. Those companies may want to engage a corporate financier.
Go and find me a backer.
Yeah, go and find me a backer. And that's where all those fancy pitch decks come in play, and fancy slideshows and stuff. And half of their job is, taking a company and actually making the financials legible in a kind of concise and appealing way. So those advisors are kind of useful. At corporate finance people are useful in terms of both helping companies find access to a different source of capital if the banks aren't quite cutting it, and they want to explore private equity as an opportunity. And as I said before, private equity is not just about the money. Where it works well, it's about money plus plus professionalism, plus network, plus added value. But if you're in-house, you'll have a variety of advisors trying to both look at the deals, but then have people do kick the tires on the finances initially. So put together the deal sheet themselves. So a lot of the people that we work with, they do that in-house. I think they have the expertise to say, well, this is what we've done on previous deals. This is what our portfolio requirements are. And by portfolio requirements, I mean what it says on the tin. Depending on the size of institution, you may have more or less criteria as to what assets you're prepared or what companies you're prepared to invest into. As simple as that. So what deal ticket, what money you're prepared to deploy, what size of position you want to take in the asset. These all things need to be factored together to make it a viable transaction for you. Does that make sense?
Yeah, no, absolutely. Let's assume I'm a family office and I'm sitting there and I know I've got an amount of money to put forward. I've got, I don't know what you think a big deal is.
Yeah.
Let's say I know I'm going to have 50 million to put forward into a deal, and I know I could go out into the market and I could buy a company that's valued at 50 million and I could just pay for it with cash.
Yeah. Don't do that.
No. Or let's say I'm thinking, well, I can use that and I can also take out some borrowing. I can go to a debt finance company and we can get borrowing. We can get
do that.
Yeah. So this is my question. So talk to me about that thought process around why someone structures a deal through debt financing, because to my mind as a non-corporate person, and this is me very much laying my ignorance at your feet, Ragavan, it's a bit like, my brain's going, well, if I could buy a house in cash, why would I not buy it in cash? Or if I can buy a car for cash and
don't use your own money when you can leverage.
So why is debt financing and why is debt so an important and popular part of this process? Is it because it lets you buy something bigger?
Yes, but also risk as well.
In what way?
Well, you're going to be losing your money, essentially.
The debt provider's still going to want their money back if
that's their problem. I am, of course, kidding. No, and they'll be securitized with a debt package. It's not very popular with banks, but no, I think the point is it's structured. Well, there's a couple of points. So you have 50 million to invest. You don't invest into one asset. You don't. Yeah. What you're doing is you're taking a thin strip of equity, and you're making it buy more by borrowing from banks essentially. And that's not as easy said or done. Banks are not going to be lending anyone money. So
sure.
if you're taking a lot of money from banks, the underlying asset needs to be revenue generating, and this is why I'm talking about private equity, not talking about startups here, because with a startup you're the reason you're probably going to business angels is because you can't get the money you need from a bank. There's nothing to lend against. So a bank is saying, no, if I can't actually make sure that at least my loan can come back before anyone else's money comes out, I don't have the appetite for it. So the way it'd be structured is, you'd probably, if you're sensible as a private equity investor, not only be putting your own private money up, you'd be going in with, people so people you've done deals with in the past. So there'd be more than one private equity investor. So that way the risk is defrayed amongst a variety of investors. And then you'd be leveraging that with the bank's money, who would be, ahead of you in a queue if things went wrong. But if things went wrong, they'd also be ahead of you in a queue in terms of their exposure. Does that make sense?
Yeah. We spent a lot of time thus far talking about the deal from the buyer's side, from the seller's side. What we haven't talked about, Ragavan, is the deal from the lawyer's side. So, because I'm a private client lawyer, right? And most of the people who listen to this podcast, historically at least, have been people working in the private wealth space. We all kind of get an idea as to what it's like being a private client lawyer and dealing with those sorts of clients. And the exposure we get to work in your specialism tends to probably come from watching TV shows like Suits, which I'm sure is not realistic.
Oh, no.
So talk to me about what it is to be a corporate lawyer, what it is to be a lawyer specializing in private equity. What does the work life look like, and why is it that you find this sort of work so interesting?
I like doing deals. I like getting things done. And I know that people in other spaces, lawyers, do get things done as well, but it's the pressure of doing things in sometimes a very short time period, but also in a defined time period. If I can do a sidebar, I trained at a very old school law firm that specializes in private client. I won't name them, but they're well known in the space. I did 2 seats for my sins in private client for my sins. One because after the first seat, they wanted me so badly, I had to do my second one. But it wasn't for me. I can't do what you do, Aidan. It's just there's 40 different matters you have to be all over.
Oh, yeah, at least, yeah.
Yeah, at least, yeah. And people phoning you up every minute about those 50 different, it's increasing every time I say it matters. Whereas I prefer to be fully immersed in a project and make sure I'm just doing that thing. There's monomaniacal about the detail of that project, making sure all the momentum is being driven on that project, making sure it gets done efficiently. And I like that. I'm a bit of a nerd. I like doing deals. I like having a nice list. I like being assiduous for that list. And that's what I like about it. I don't do myself a disservice. I'm not doing brain surgery here. It's more kind of just being relentless. That's the skill of a corporate lawyer, is to be relentless and get things done. All the while, hopefully, with a smile on your face and making sure you're keeping everyone on side, because that's a skill in of itself. I'm not a contentious lawyer. I don't like to bulldoze people or waste time point scoring. I just like to get things done. And there's an art in getting things done, which kind of appeals to me.
It's that kind of that swan analogy where everyone's furiously paddling below the surface, but to your client, to the other side, everyone's just sort of keeping everything nice and light and sort of friendly. But you've got to make sure that underneath you've got that defined time period. It's going to get done one way or another, and that might mean, and God forbid, staying up late into the night to get the deal done, or over the weekend.
Yeah, exactly. I mean, from a client point of view, there's hundreds and hundreds of pages, and they need to know it's going to get done right. But they don't actually know whether it's being done right. They're just seeing whether things are running smoothly.
Yeah.
And so you need to have both. You need to get the detail right, but everything needs to go smoothly, because that's actually what people tend to focus on a lot, to be honest with you. People always focus on documents on their names.
Yes.
If you get their name wrong, big faux pas. It's equally important to make sure things get done smoothly, I find.
Do you find that process differs between acting on one side versus the other? Do you find yourself acting on more the purchasing side or the selling side?
I find myself more on buy side mandates. I guess that's because of my client profile. And also, if you're acting for private equity investors, then as part of the deal, there's often an M&A process as well, where you're buying a company. Not always. And I do act for sell side as well. I like keeping my eye in, because it's the other side of the same coin, really. I act for a lot of very smart, sophisticated individuals. They make my life much easier by having clarity as to what they want to achieve, being consistent and being helpful. And because I've been working with them for 10, 15 years, it's kind of we know each other's game. We know what's important to each other, and we know the best way to deliver. I mean, I like developing long-term relationships with people. It's something that I really enjoy.
Yeah,
that's a part of the thing.
So does that mean, because you're frequently acting on the purchase side on the buyer's mandate. So I did a corporate seat for what it's worth as a lawyer, and the two exercises that I enjoyed least as a corporate lawyer, which you're going to come to now, which are due diligence and disclosure.
Yeah.
Presumably, am I right from my recollection?
Fun though.
Well, you and I have different definitions.
If you can find something in due diligence, we can like price chip and say, "Oh, well, you haven't done this."
Yeah, you're definitely a corporate lawyer. So this is where the meat of the deal is. Kind of the review is going to get done. The kicking of the tires.
Yeah.
Talk to me about what due diligence and disclosure are in the most general senses in corporate transactions, but how they differ or what they involve, particularly in private equity. Yeah.
Hopefully a lot of people will be kind of vaguely aware what it is. It's just investigating a company. So you're looking at all the different records of a company. It's corporate records, it's customer contracts, it's
like
supply
doing your searches and
contracts.
inquiries on a property when you purchase
Exactly.
it. Yeah.
It's your kind of kicking the tires in a way that's relevant to different areas. So on the legal side, that's predominantly going to be contracts and any kind of legal exposures that the company may have. So you're asking questions about whether it's involved in any substantive litigation. If it's an intellectually property rich target, you're looking at all the registrations to make sure that if you're investing in a company on the basis it owns this really important patent, one of the key pieces of due diligence is going to be, do you own this patent? And making sure you're verifying the information that you think is accurate, but you need to make sure it is accurate.
All the real estate documents are in place, all the employment contracts are in place. That it's a company that is running properly and has everything it's supposed to have.
And no company is run completely properly, and we expect that. But it also then therefore gives you a leg up on, I think the best private equity deals work where you already know before you enter into the transaction how you're going to improve the company. So having a bit of knowledge about how you're going to improve the company is going to help you move the company to another level. Because as I said earlier on in the piece, the deals are all about the exit, which seems a bit odd, but they are. So you need to understand if there's lacunas in some of the drafting of their employee handbook, how you're going to fix them before you actually, proceed on the journey. Because if you can, the investment's going to work well where beforehand you can say, actually, I have a contact in this space and I can introduce the company to this client, and therefore this will add X amount of revenue immediately. And without my money, without my contacts, they were able to do that. When you're talking about due diligence, looking at legal stuff, but also about financial due diligence, that's equally, if not more important a lot of the time, making sure the books and the are accurate and not being made up. You'd be surprised how many things are made up sometimes. It's like people think people won't examine it, but as soon as you examine it, it falls apart like a house of cards and you move on, don't you? Due diligence is making sure you don't take the initial responses to your questions at face value. You deeper dive. And I think people, especially if you're involving external advisors to ask the questions, your respondents are going to be taken more seriously if they're dealing with a law firm or dealing with an accounting firm who are specifically looking to catch them out almost. And
presumably, and so you've just referred to it there, this isn't all work that's going to be done by a corporate lawyer, because you may be...
I say it's going to be done by me.
No, you don't better than I am on TUPE or on real estate leases and these kind of things, but it involves a whole team of lawyers probably bringing in different specialisms. Maybe they're all at Collyer Bristow.
And
a deal isn't just a corporate lawyer sitting on top of a pile of other corporate lawyers. It's a whole group effort to make sure that the sort of the right people, maybe some accountants to look at the accounts, the right people are looking at the right things at the right time.
Yeah, that's completely spot on, Aidan. That's part of my job is to coordinate other teams, and I'm very lucky at Collyer Bristow because we are a full service law firm. I have access to some really excellent real estate lawyers, IP lawyers, commercial lawyers, dispute resolution lawyers, private client lawyers. But you need that. You need people with their expertise in the areas. And my job is to direct them and make sure they're not focusing on the wrong areas. But you need that deep knowledge in order to assess a company properly.
Yeah.
So I feel very lucky, and it's not just me. It's very rarely just me. It's a whole team of people involved, even in the corporate department. I'm very lucky that we have very great senior associates and other partners also help me out. So it's all very much a team effort. Very much team. Yeah. You only, yeah. The art of leadership is having the right team around you. I think.
I couldn't agree more. I pose to you due diligence and then disclosure, and my brain goes, but you need to disclose things in order to conduct due diligence on them. But am I right that the disclosure that comes afterwards is more promising the things that you've disclosed rather than it being the other way around?
You've got the order right, Aidan.
Great, that's all I need.
So due diligence comes first, and due diligence is about investigating the company.
Right.
Disclosure is about saying facts and circumstances which are at variance to the warranties you've given in the acquisition documents. So whereas due diligence is about the buyer finding out more about the company, disclosure is more about the seller protecting themselves from actions under the acquisition documentation, and in particular, warranty claims. So as part of the acquisition process, the buyer will want various statements about the state of the company, and those are called warranties. And the disclosure process is a mechanic by which the seller says, notwithstanding what I've said in the warranty, the real truth of the matter is X. So I'll give you an example. You may give, as a seller in the acquisition document, a warranty that all debts owed to the company will collect within 30 days.
Right.
And that's important to a buyer because then it knows that after it's acquiring a company based on a certain cash position, and all those debts are good debts, and then be collected in within a certain time period. And the disclosure against that warranty might be that you as a seller may know, actually, I know client X always pays a bit late, or they're going to pay a bit late. And they disclose, well, actually, this debtor is not going to pay within 30 days. They're going to pay within 45 days. Well, you wouldn't actually probably say that. You'd just say they're not going to pay within 30 days. Mm-hmm. And then you'd give the buyer complete transparency on that particular client and say,
why would you have warranted it if you knew it wasn't true?
What you're giving the exceptions.
Fine.
So you're saying
this is the position.
This is the position, except that the following aren't true.
That does make sense. It's a blanket rule. This is the default position.
Yeah.
But here are the exceptions to the rule that you need to be aware of.
And some warranties they can't qualify. So if one of the major warranties when you're buying the shares in the company, that I own all the shares.
Right.
So it wouldn't be sufficient to say I disclose I don't own the shares.
I take that point.
Yeah. Across the whole suite of warranties, which can run in the document to 30, 40, 50 pages, there are going to be some warranties which can't be given absolutely. There's going to be some deviations from the factual matrix, which makes the warranty untrue in some respect or another.
Because you don't know the answer to the question? Is it possible? Like they want a guarantee. My brain's going to property where you kind of give full title guarantee or limited title guarantee. I don't know the answer to that question.
Properties are weird, so the rules don't apply to them. It's caveat emptor and all that Latin.
You know that sort of like. That document got lost, so I can't evidence that thing to you because the document doesn't exist anymore.
Yeah.
So am I then just disclosing, you're going to have to take a view on it because I can't give you the guarantee you're looking for?
No.
That wouldn't fly.
No, that wouldn't fly with me.
Fine, all right.
My next question would be, please can I have an indemnity covering me full exposure on this thing. Okay. It's this is about risk apportionment and this is your risk because I'm giving you all the money. So
what I remember from the very, very limited time, X number of years ago, when I got involved in some of these processes as a trainee, was the turning of the document, the back and the forth. So we draft it, and then probably very late at night we send it back to you, and you draft it, and then even later at night you send it back.
I feel like it takes a slight trauma from you, Aidan, with the late nights, the weekends.
We can talk about this after this recording. I'll tell you my traumas. Does that mean there's, particularly for the disclosure letter, I think it's usually a letter.
Yeah.
There's quite a lot of back and forth over the specific words used, and when a track change comes back and they've changed the word from this to this, there's a reason why they've changed that name. Is there from quite a lot of debate around how to frame a disclosure letter, or are there accepted terms?
There's kind of accepted generally what full and fair means and accepted levels of disclosure. The detail is really important because essentially what the buyer's going to, if you come back and say to the buyer, yes, there's a piece of litigation, end of sentence, they'll be like, can you please tell us a bit more before we proceed with the transaction? There are some disclosures which will elicit more of a reaction from buyers than others. So, and if it's something they're sensitive about, they're going to want more detail. And that's why on the disclosure letter, you may flip-flop about, how much detail is going in there, because the buyers want transparency, because ultimately they know that if they're fixed with a fair disclosure, they won't be able to claim under the warranty. So their ability to price adjust by way of a warranty claim has immediately been stymied by the disclosure and disclosure letter. So it's kind of a balance.
Who is looking at the responses on the disclosure letter and making a value assessment? Is it the client because they're the ones involved in the business, or they want to be involved in the business, so they're going to take the value judgment? Or are they looking to you to give them a steer, going, "Yeah, that seems like a reasonable response"?
I think it's a team effort.
Right,
it's a team effort. So we'll have a go at saying before it gets to the client, these disclosure. If we're on the buy side, these disclosures aren't up to muster. Please give us more detail. And then it'd be a question of discussing with the client and then stress testing it with them, because sometimes I've had situations where I thought something was really important and the client's gone, it's not important.
Yeah.
Or other situations where the client's been, I didn't think that was important. I go, no, this is really important. This is really important. So it's a collaborative effort based on projecting where the company is going to be post acquisition. And because the last thing you want to do as a lawyer, and some dispute resolution lawyers would disagree with me, but I don't, and I don't think any of my clients would favour litigation as a way of adjusting a price. The documents are there to set a benchmark and rely on, obviously. But if there's anything that's coming out which you're concerned about before you've actually signed on the dotted line, there needs to be just a conversation about how that price can be adjusted or managed in a different way. Whether that meaning changing the structure to put some of the money in escrow to account for a specific issue that's been identified in due diligence or in DD. Actually, one of my favorite stories involves my a former a place where I trained, where I was doing the due diligence and I identified that they'd made a mistake on some of the tax planning.
Right.
And that resulted in a multi-million escrow when I was on the buy side buying from their clients. So
congratulations.
So it just came to me. So that was an interesting one. But so it's kind of, well, I wasn't looking for it, but if you're doing due diligence, you need to actually make sure you look at the detail of the documents and not assume that what other people have done is correct. And if you see there's a variance between what was, for example, in a clearance letter and what was actually implemented, then you need to advise your clients accordingly, and the deal structure needs to change accordingly to mitigate the risk of anything coming up, even if it's a theoretical risk. If it means that there needs to be the whole back on the consideration, that's how you need to attack it. Yeah. And that was a long way of saying, look, don't try and
shortchange. Don't shortcut your disclosure due diligence.
Be assiduous about your due diligence if you're a buyer. Be assiduous about your disclosure if you're a seller, and try to have some adult conversations which don't involve litigation to get to a better result for both parties potentially.
So let's assume we'd all shook hands at the beginning. We'd have agreed we'd all work great together, and we've come up with some heads of terms, and they've been rigorously negotiated by Ragavan and his colleagues. And then we've gone through the due diligence process, and we've written the disclosure letter, and the SPA, the agreement is sort of looking in pretty decent nick. At that point, are we all just kind of moving towards the completion, or are there elements to the transaction that still have to kind of have their I's dotted and T's crossed before we finish?
Yeah, the SPA is the kind of main document, and it kind of drives all the other documents on the acquisition side. I mean, if we're talking, just to circle back to private equity for a bit and that focus, I guess the documents, and I kind of mentioned a bit earlier on that you'll have an SPV, and they'll have constitutional documents which are equally important as the share purchase agreement, in terms of there'll be a shareholders agreement and articles, and that's setting out the rights of the shareholders at SPV level, which is their kind of economic rights, essentially. And it could be, if you have a management team as well who have equity at topco SPV level, it may be that you have good and bad lever, and you may have heard those terms. We could do a whole different podcast on that if you want one day, if I'm invited back. To go back to your question, it's not just done and dusted by that. There's a whole set of ancillaries that sit behind the share purchase agreement. And often, though, you do find that there isn't a lag between often the share purchase agreement is one of the last documents to be agreed, because a lot of the ancillaries would be negotiate at the same time as you're doing the heavy lifting on that document. You're negotiating your resignation letters, your stock transfer forms, your board minutes.
I remember those.
It's coming back, is it?
It's coming back.
Yeah, so it's more like you do those and then you do the other.
They kind of move forward roughly sort of together, don't they?
Yeah. And it's, you're running several different work streams and you're having several different people within the deal team working on those elements as well. On the disclosure letter, maybe a separate work stream, people focusing just on that. You may have a specific IP issue identified by our IP team. You need to assign a piece of IPR. You've noticed doing DD that they had a consultant working on this part of the project, and therefore we need to make sure that IPR is not sitting in that consultant's name. It's been assigned to the target.
Doesn't exist anymore. And no one signed it over.
I love that. Yeah. Does it exist anymore? Yes. There's one can share. How do we restore a company? Yeah. A lot of issues need to be brought together into at one time. So it is not normally one and then another and another. It's all running at the same time.
So let me ask you the human interest story, the human interest question, which is the one which is probably the single biggest reason why I didn't become a corporate lawyer, which is if there's so much stuff to get through and there's so many parties involved, why do deals always end at like 3 a.m? Surely the answer is just to roll it over to the next day. Is there some kind of penalty where we've all agreed if we don't complete on the 10th of June, we're all going to, why do these things always go so late, Ragavan?
I very rarely have a deal.
Do you sleep?
I'm a vampire. I just live off vibes and the deal getting done. No, I mean, to be honest with you, nowadays, it's a rare deal that goes that late into the night. Yeah, I think people are much more kind of. I'm not going to lie, I loved it. It's just the status symbol, right? And also I think it's...
You're the last holdout. You don't want to be the person that goes, guys, should we defer?
Yeah.
No, let them be the side that breaks first.
Yeah, exactly. Breaks first, psychological warfare. Just withhold the biscuits till they agree, okay? Don't let them see the biscuits.
The champagne is not your ice.
Yeah, exactly. But I don't ever aim for that because it's just bad organisation. I like to be efficient. And to be honest, I don't think, it used to be a sign of machismo, I don't think clients are going to thank you for closing that late. Everyone's got lives. Everyone's realized that you can just do things efficiently. I think what is good is to have real concrete deadlines that focus minds. And that was the only use of utility of a 3 a.m. because people were thinking, I'm locked in this room until I agree. So I'll make a decision. And if you're in a transaction where no decision is being made or there's so many different stakeholders, you can't get movement forward. That's the benefit of having a deadline. Yeah. It kind of focuses people's minds to get things done because sometimes the decision has to be made even if you don't have perfect information. Sometimes someone has to give way just because someone has to give way to move forward and do the reasonable thing. So very rarely have deals complete that late. I don't mind it. I find it bonding. As you certainly learn a lot about yourself and your team and your clients if you're working. And I'm sure
people places to get takeaway late at night.
Yeah, exactly.
I mean, in all seriousness, I guess the reason why you might finish late, going back to the kind of theme of this podcast, is because you're working across multiple time zones. So if you've got New York-based investors and they're working to their business hours, well, their business hours aren't necessarily your business hours. Yeah. So you may be closing the deal later because New York is running 4 or 5 hours behind.
Yeah, I mean there are some genuine decisions made around timing because of that. Also, you may want to close a deal at a certain time because otherwise you have to make an announcement to the market today, and you want to make it in the morning. So there are genuine reasons for doing deals sometimes at that time. You have to do a deal before a year end, and therefore
before Christmas.
Yeah, or before Christmas, or before your main stakeholder is flying off to Gestad or whatever it could be.
Can't sign the documents anymore.
Yeah, whatever.
I suppose DocuSign's probably made that quite a lot easier.
Exactly. That's changed. It's been a game changer until someone's off a mountain and can't click her phone. But yeah, it has been a game changer. But no, we don't do as much of that as we used to, sadly. But it was always a benefit of focusing minds. I do remember doing a deal where at an offices of a big 4 accountants, and there were about 20 or 30 parties involved. And then that occurred to 5 of the parties involved because of the amount of people involved. They suddenly had leverage because everything else had been agreed apart from their remuneration. So we had the management team suddenly go, actually at 3 a.m, they go, actually, people have spent hundreds of thousands of pounds so far. I wonder if we could just push our salaries up a bit.
You don't want to back out now.
And they managed to push it through. And then we had to change all the numbers in a lot of documents. There was lots of law firms and people involved. People weren't best pleased, but they got it done because they had leverage.
So I guess the question is, and so I never got invited. This is my final point, because we've now officially, all the documents have been signed.
Yeah.
As a trainee, I never got invited to any kind of champagne celebration. Is the champagne?
You come along to our next one.
Thank you, Ragavan. Is the champagne really as good as it sounded when the corks were being popped behind the door when I was a trainee?
Absolutely, I can confirm. Without a doubt.
And then, of course, you're on to the next deal.
Exactly. Off to the next day. Money never sleeps, Aidan, and neither do I.
Evidently, Ragavan, you've explained to everyone that you don't sleep. Thank you so much for coming on today. It's been really wonderful having you talk us through this process.
Thank you for having me.
Ragavan from our corporate and commercial team here at Collyer Bristow.
Thanks so much.
Thanks for joining us today on the US-UK Tax Talk podcast, and my thanks again for Ragavan for coming on to talk about private equity. A reminder that we're now releasing episodes on the first Wednesday of every month, so like and subscribe, and that way you won't miss an episode. Also, if you give a comment or thumbs up this episode, it really helps the algorithms promote the episode more broadly, and then we'll be able to share you with more people. Finally, a reminder that all these recent episodes are available on YouTube, and so make sure to check out Collyer Bristow's YouTube channel for our video versions. We'll see you next time.